What is up, guys? D. Chantilly here, and today we'll be talking about Shift4 Payments. And some people have been comparing this company to Square. Some have been saying this is the next Square. And so let's just take a look at it. Shift4, and that's just what I'm going to call the rest of the video because I don't feel like saying Shift4 Payments every time. So Shift4 had its IPO on Friday, and shares jumped more than 45% on day one. And what Shift4 does is it's a payment processor mainly for the hospitality industry. So some of their customers include Popeyes, Caesars, Outback, KFC, Denny's, and my favorite place, Cold Stone. And Shift4 actually priced above its expected range. It was expected to be between $19 and $21 a share. It got $23 a share, which means the company raised about $345 million in this IPO. And in this video, we'll go over the class structure of the stock, the financials, the opportunities I see, and some of the concerns for this company. And first we'll go over the class structure, and there will be timestamps below if you really don't care about how the class structure is set up. So just go in and click to the part where you're most interested. And for this company, there will be three classes of stock, Class A, B, and C. Class A will be entitled to 1 vote per share, and they will be authorizing 300 million of these shares. And keep in mind that authorizing shares does not mean there will be 300 million shares available for purchase. Authorized shares are the maximum amount of shares a company is allowed to issue to investors. They issued 15 million of these shares in the IPO, 17,250,000 if the underwriters exercise their full option to purchase additional shares. And just FYI, if you sold 15 million shares for $23, you get $345 million. That's how we know how much they raised during this IPO. And then we have Class B stock, which will be entitled to 10 votes per share, but will not have any rights to receive dividends or to receive distribution upon dissolution or liquidation. 38,373,190 of the Class B stock will be owned by Searchlight, a private equity firm, and the founder, Jared Isaacman. And then we have Class C, which will be entitled to 10 votes per share, but like Class A, they will be entitled to receive dividends. And upon dissolution or liquidation, after payment in full of all amounts required to be paid to creditors and holders of preferred stock having liquidation preferences, if any, the shareholders of Class A common stock and Class C common stock will be entitled to receive a prorata of our remaining assets available for distribution. Searchlight and Rook will own 20,432,521 of these shares, and if any Class C stock is transferred to any other person, it will automatically convert into fully paid and non-assessable shares of Class A common stock. And the book definition of non-assessable is a stock in which an issuing company is not allowed to impose levies on its shareholders for additional funds in order to make further investments. The maximum liability of the purchaser of the stock assumes is equal to the initial purchase price of the shares. And all of that is just a long way to say you can only lose what you put in. So if you buy $100 worth of stock, the maximum you can lose is $100. And here's a breakdown of the voting structure and the financial interest and things like that if you're interested. And now time to welcome all the people who skipped the share class section of the video. And now it's time to get into the financials. And let's take a look at the company's full year 2019 financial data. Payment-based revenue came in at $643.6 million, up 32.6% from 2018. Subscription and other revenues came in at $87.8 million, up 16.4% from 2018. And total revenue came in at $731.4 million, up 30.5% from 2018. Network fees and other costs of sales, I just combined them together, came in at $552 million, up about 34.66%. from 2018. Gross profit was up 19% from 2018, coming in at $179 million, and gross profit is the profit a company makes after deducting the costs associated with making and selling the products or the costs associated with providing its services. Gross profit is not net income. When you add up their general and administrative expenses, depreciation and amortization expense, professional fees, advertising and marketing expenses, and restructuring expenses, it comes out to about $185.1 million, bringing them to a loss from operations of about $6.1 million. Then they had their other income of about $1 million and had an interest expense of $51.5 million in 2019. And in total, they had a net loss for the year of about $58.1 million, which isn't all that bad for a growth company in my opinion. Revenue growth is strong. It's up about 30.5% for 2019, and net cash provided by operations continues to be positive. We do have some first quarter data coming out for 2020, and the numbers look good, especially year over year. So just keep in mind, year over year is now from the first quarter 2020 over first quarter of 2019. And payment-based revenue came in at $176.4 million, up 31.6%. Subscription and other revenues came in at $23 million, up 9.52%. Total gross revenue came in at $199.4 million, up about 28.6%. Gross profit was $44.5 million, up 15.28%. Total operating expenses came in at $36 million, down 9.3%. Interest expense came in at $13.5 million, up about 8%. And net income was negative $0.52 million, which is actually a 61.48% increase from this time last year, where it was negative $13.5 million. And so the quarterly numbers look very strong. Revenue and gross profits were up. Operating expenses were actually down. Net income was better. Still not profitable, but up more than 61% year over year. And now let's take a look at some of the opportunities I see for this company. And they're in a fast growing industry. According to 2019 findings from the Diary of Consumer Payment Choice, they did a study on a demographically representative sample of 2,873 individuals that participated in the study and reported all their payments and transactions over consecutive days staggered throughout October 2018. Yes, that was a very long sentence. But consumers used cash in 26% of transactions, which is down from 30% in 2017. Debit cards were the most used instrument, accounting for 28% of payments. Credit cards accounted for 23% of payments, which is a 2 percentage point increase from 2018. And cash was most heavily used in transactions under $10, where it represented 49%. And so society as a whole is increasingly moving towards digital payments and choosing to use less cash. Just look at how the stimulus checks were delivered. According to an article written by MarketWatch on May 11, 2020, there were 110 million direct deposit money transfers versus 20 million paper checks. There are many reasons for using less cash and more electronic options. Some include more convenience, it's faster, we don't have to be in the same place. I may not have, and if we are in the same place, I may not have $10 on me, but hey, I'll cash app it to you. Or I forgot my wallet, I'll use my phone. And it's also a lot cleaner. We know cash carries a lot of germs, and with the pandemic going on, people are choosing to use their phones. I could use Apple Pay. I can, there's better ways than cash to keep yourself from contracting the virus. And it's also a lot safer. If someone takes my wallet and my card's in it, I can just lock my card, order a new card. But if there's cash in there, well, you're just, SOL. And so there are many reasons to use a card or credit card, debit card over cash. And society as a whole is moving very quickly in that direction. And Shift4 will be a big beneficiary of that shift to more digital payments. And as the economy begins to reopen, places begin to reopen, people are going to start to come out. I don't think there's going to, come out and be a V-shaped recovery like most people are thinking, but they're going to be open. The sit-ins, the hotels, the sit-in restaurants, that's going to be a big boost for this company because they're going to get more payments going through their system, more transactions. And so that is going to be a big plus. And they already posted a pretty good first quarter with all the shutdown and all the stuff going on. And so the company sees more than 3.5 billion annual transactions. They have over 200,000 current customers, over 200 billion in payment volume processed annually. And it's a nice growing company with a lot of big clients. Remember Popeyes, they have Bonefish Grill, and just companies like that. But they're doing a good job of also serving small businesses. And so to wrap the opportunities up, it's in a fast growing industry. It's well established. The revenue growth is encouraging, and the bottom line is also getting better. But what's the downside? Well, the downside is they face very tough competition. They even mention it in their S1, saying they face substantial and increasingly intense competition worldwide. They named some of the companies as well. For third-party processors, they named Chase Payment Tech, WorldPay, Global Pay, and some others. And for integrated payment providers, and I'm sure you've heard these two names before, Shopify and Square. And those are very, very tough competitors. And so they're in a very competitive space, and they also have a lot of debt. According to their consolidated balance sheet as of March 31st, 2020, they have $703.4 million in long-term debt, and their debt-to-asset ratio, which is total debt divided by total assets, is very high. It's 0.99. It's almost a 1. And when you look at the breakdown of the maturity dates, and I know this is as of December 31st, 2019, and they've taken on some more debt since, but it kind of gives you an idea of when the debt is due. And so they don't really have a big payment due until 2022 with a $26.2 million worth of debt maturing. And then 2024, they have $490.2 million of debt maturing. And I believe they plan on using $285 million of the money raised in the IPO to pay down some of the debt, so that is a positive. And so, to summarize, my two biggest concerns for the company, in my opinion, is the amount of debt the company has and the fierce competition. And it's only going to get tougher. And so, what do you guys think about Shift4? Do you think it's going to be an excellent stock to own? Do you think it's going to be a dud? Do you think it's going to be a middle of the road? What do you guys think about this company? I look forward to seeing what you have to say down in the comment section below.